Hello everyone, I'm Marcello La Rosa, the CEO and co-founder of Apromore, and I'd like to give you a warm welcome to this seminar on process mining in banking. Let me start by acknowledging the traditional owners of the lands we are in, the Wurundjeri people of the Kulin Nation, and pay my respects to their elders, past, present, and forthcoming. So it's a pleasure to be here with Nigel Adams. So Nigel is quite experienced in the banking sector. He's currently the director of Hatton Advisory, but he has worked for a couple of large banks here in Australia, National Australia Bank and ANZ Bank. And before that, he was a consultant for KPMG. Interestingly, now Nigel has not yet abandoned the financial sector, but is looking at it from a different perspective, while being involved in different aspects of banking, from managing global payment operations, cash operations, financial crime, and business performance. Is now looking at the banking sector from a different lens, that of research. Nigel is in fact doing a PhD on process mining in banking with a specific focus on compliance, together with me at the University of Melbourne. So for those who don't know me, I'm Marcello La Rosa, the co-founder and CEO of Apromore, and I'm also a part-time professor of information systems at the University of Melbourne, where I lead a research group specifically focused on process mining. So, Nigel, thanks a lot for joining in today, and I'd like to have a conversation with you on the status quo of the banking industry and explore with you where process mining can help the banking sector and how. So this chat originates from an idea that we had a couple of months ago that led to a series of white papers that you authored on process mining in banking. And in this white series, you explored 5 key use cases that you deem very relevant for process mining in banking. So how can process mining be used to aid operational excellence in banking, to support digital transformation, to help banks manage operational risk, to bring about customer journey transformation, and how to support banks in rolling out and de-risking new operating models. And it is against this backdrop that I would like to start this conversation. So very quickly, housekeeping before we get going. So you'll be muted by default. There is a Q&A section in Zoom. You can use that to ask questions. I will go on a conversation with Nigel, and we will have a dedicated Q&A sessions with participants at the end. But feel free to ask questions along the way, and if we can fit them into the discussion, we will certainly do. And also there's a chat functionality, and I've seen that some of you have already started using it. You can use that to share with everyone your general comments, thoughts, and opinion. And of course, you can feel free to remain anonymous if you wish to do so when asking questions or putting out your comments and thoughts. The session will be recorded so that we can share the video for those who weren't able to make it. So let me start by making sure that everyone is on the same page. Let me launch a quick poll to get a pulse about our common understanding of process mining. So what's your experience with process mining? All right, I guess we've definitely reached the quorum with over 70% of the participants responding, and we can see that some of you are quite experienced, but the bulk have just started or are about to start a process mining initiative, or they are still at the proof of concept stage. So they are still considering whether process mining would be the right approach and technology for you. So let me take that as an opportunity to talk very quickly about process mining. The idea of process mining is very simple. These days, almost all the activities that we perform, especially in a banking context, happen on top of some system or application, and undoubtedly they leave some traces in the form of event logs. The idea of process mining is to gather the digital footprint left by these processes. Take that as a starting point to collect and ingest this data into a process mining tool to get some insights into how these processes work. Think, for example, of a payment process, of a loan application process, right? Or a debt collection process that happens in a bank. So the idea is to look at the data that has been left by the systems and applications that have supported this process and take that as a starting point to first reverse engineer the process map. And through that, get an understanding of the structure, the performance, and the level of compliance of these processes. So are there frictions in this process? Where are we wasting time? Is there any rework, repetition, bottleneck? Are we complying with the regulatory requirements? If not, where do we violate these requirements and what's their negative impact on the overall process cost and performance? And clearly, process mining is a means to a goal. The goal is to ultimately improve our business, improve our operations. So gain insights from this analysis and use this as a starting point to assess and implement different intervention opportunities. And that's a lot of promises behind those words. So process mining promises us, first of all, to achieve transparency about our own operations, to get that intimate understanding of how our processes really work. Not the way we imagine it, but the real process as it is provided by the evidence of the data that we've used as input for our analysis. And that transparency works as an enabler. We can use that to help our organization improve efficiency and productivity, enhance quality and customer experience, help our company better monitor governance, risk and compliance, and achieve higher levels of operational agility. And over the last decade or so, a number of process mining techniques have been developed, both from commercial vendors, tool vendors, as well as from academia, that can help us achieve these different business outcomes. So chiefly, many of us have become familiar with techniques from automated process discovery. That's to say the key capability of process mining. It allows us to reverse engineer the process model to achieve transparency. There are also techniques from performance mining that help us understand friction points in our process performance and identify opportunities to lift these issues, to remove these friction points. We can also use techniques from variant analysis to compare different variants of the same process. For example, those where customers have had a good experience versus those where they've raised complaints, and try to understand from the differences the root causes for these complaints. Or we can use techniques from conformance checking to help us compare our as-is process, the one that we discover from our event logs, with a to-be process that defines a desired situation or identify non-compliance issues against a set of business rules or regulatory requirements. And finally, we have a range of emerging techniques that help us raise our level of agility in terms of process and so operations within the organization. So we can use scenario analysis, so for example, through process simulation by linking process mining with simulation in what we call what-if process mining. as well as techniques from predictive and prescriptive monitoring to help us understand how to act upon our live operations, like while our loan applications get assessed, while our payments get done, we can intervene to avoid the eventuation of problems. So that's clearly a lot in the process mining agenda, Nigel. But let's try now to put things in context. I would like to start against this backdrop to understand the specific context in which banks are navigating these days. So, Nigel, how has the banking industry changed in the past few years, and what's happening now?
Hi, Marcello, and hi, everybody out there. I think it's tempting to say that we've seen obviously lots of technology change, new competition, more regulatory oversight, but those themes have been happening in banking for 50 years plus. One of my first jobs at the NAB, I had a team member whose first job was to handwrite statements. Technology has been impacting banking for a very, very long time. So the thing that's different for me in the last couple of years is the pace and reach of technology change. There's no part of the bank that's left untouched now, whether it's sort of, governments looking at setting up their own digital currencies, creating home loans that can sort of be approved within 10 minutes. It is now touching every part of the bank, including areas like trade finance, which have been, decades in the making, waiting for someone to automate all that paper. Then from a competition perspective, it's not just banks taking on other banks trying to consolidate. You've got the global tech giants sort of, trying to cherry pick and eat the best and most valuable parts of the value chain, as well as all these sort of really young sort of fintechs trying to find their own niche. And finally, from the regulatory oversight, we've clearly in most industrialized countries, there's been reputational issues with banks, and there has been increasing regulatory oversight. More and more regulations coming in every month that need to be adhered to. And of course, in the last couple of years, we've been dealing with the pandemic as well, which certainly hasn't made sort of things any easier. So
in light of all these changes, what do you think is the biggest challenge that banks are facing today?
So I think it depends on the your perspective. If you're coming at it from a fintech perspective versus a mature bank, and I think we'll take it from a mature bank to start with. One of the things they're dealing with, because they were such early adopters of technology, they're having to face into lots of legacy issues. That's not just systems legacy, but decision legacy. In the 90s, many banks were sort of very much oriented around products and not customer centric. So you had so each product system had its own customer database. Yet, how can you create a single view of the customer if you've got multiple systems all containing various customer details? You then had decisions which were around, well, we need to try and reduce the cost of a particular project, so we'll hollow out one of those legacy applications, but we never quite get rid of it. So it's still part of the system. It's still sort of embedded in the fabric, so the interfaces need to be maintained. And then you get decisions such as, well, we haven't really got enough to fund this next step, so let's just put a manual workaround in, and then we'll fix up the manual workaround in phase 2. But phase 2 never happens. So you've got all of these decisions, which have been all made in good faith, cumulatively over 20, 30 years, that have resulted in this, this spaghetti mess of systems, processes, channels, products that is extraordinarily hard to unpick. And that, for me, that's what makes sort of process mining so appealing, because if every bank recognizes they have to move on, they have to get onto the sort of the digital journey. But to do that, you need to understand the past. And unpicking that spaghetti is extraordinarily hard, especially when lots of the people that were responsible for putting it in place have retired, they've moved on, they've gone to different organizations. So you need that process insight and the transparency you were referring to really start your transition to that next phase.
And why didn't it happen, say, 5 years ago? I mean, the process mining technology now has been around, at least on a commercial level, for over a decade. Why now times are ripe for process mining in banking? Is the technology mature now?
I think there's
before?
No, I think there's a couple of things, Marcello. I mean, I think, if you remember when you and I sort of first met, this was just off the back of, there were a couple of guys in ANZ's lending team who'd just gone through a process discovery exercise, and I was blown away. I had a deep sense that there were way more variants than we sort of actually accounted for, but I had no idea just how many possible paths there were through that end-to-end lending process that the guys mapped out. And so that was a shock to me. And, that was sort of, as an operational leader, one of the people who were sort of looking for these things. But I think what's really sort of made the time sort of more relevant now is a couple of things. One is that those techniques that you talked about, whether it's process discovery, conformance checking, the predictive monitoring, etc., have really matured in the last few years. But one of the roadblocks, I think, for banks has been this legacy, this systems legacy, this massive systems. To process a payment, it's not unusual to have 80, 90, 100 applications involved. So trying to capture all your data from those systems is extraordinarily hard. But what most banks have been doing over the last few years is they've put an enormous amount of effort into cleaning up their data and recognizing the inherent value of that data. So there's lots of work going on the banking side. And then on the I guess the tools side, much more mature tools have come onto the market around ETL, about being able to extract, transform, and load that data into systems, like sort of the process mining applications that have sort of come onto the market in the last few years. So you've got two sort of angles that I think are really making it a much more mature space.
So on the one hand, you said the technology has been maturing a lot, especially around the area of, let's say, data ingestion, so data pre-processing and then ingesting this data into the process mining tool, including the ability to automate these ETL pipelines. But on the other hand, you've also said that banks have slowly started realizing the importance of keeping their data clean. And that, in a way, is finally enabling process mining to kick off. Yet, Nigel, when I talk to banks, they tell me that they are terrible at managing their data. The data is dispersed over a large number of systems. So is it really happening, or is it simply perhaps now a problem of perception, like that bank executives still have that perception that data isn't as clean as it should be, yet that could already be enough for process mining, and they don't know?
I think that's a great question, Marshall, because I think one of the common misconceptions or mistakes is to think of banks as just one thing. You go and ask someone that works in a capital markets team and talk to them about their business, and then go into someone who works in the branch network or into a retail call center, you might be in sort of two completely different organizations. Banks are very large places, and though, someone once said to me when I first joined a bank, said, "Oh, look, we're really easy. All we do is three things. We lend money, we take money on deposit, and we move money around." And it's nice to think about it at that level, because it does make it simple. And banks have been doing this for 400, 500 years, and they're still doing it. But what's happened is each one of those areas has gone on its own journey. We talked about how we tend to focus on the manual processes and the complexity that's in there. But, banks, certainly in banks in Australia, process about 40 million payments a day. The vast majority of those don't see anybody touch them at all. Well over 99% would not be touched. Many customers that go for a credit application, it's automatically approved. But there are some that aren't, and that's part of the nuance. And when you come to that data proposition, is it where it needs to be? No. Have the banks committed significant resource, both from a regulatory perspective, they're pushing them to have better quality data, but also from a monetizing perspective, the banks realize that if they want to get closer to their customers, to understand them, they need to have much better quality data. So they've been putting enormous amounts of resource in it. But you don't sort of turn these sort of organizations on a dime. They're big organizations, and it takes time for them to fulfill it. But you can find parts within each bank that are pretty mature, and they've got good access to data, and they're great opportunities and candidates to start with.
So Nigel, thanks about that. Let's now get into the details of your white paper series. In the series, you explored 5 key application areas of process mining in banking, as we were saying before.
Yeah.
You talk about 2 areas that are quite established, and they are well-known use cases for process mining within as well as beyond banking, namely operational excellence and digital transformation.
Yeah.
Any advice on how to use process mining for these 2 specific use cases? I remember you mentioning me, this is good to get the agenda going, right?
That's
Over
very
and
much the
above
case.
all other priorities. So what can we say? Any tips you can share?
As you already know, sort of, as an operations evangelist, the idea of operational excellence, and that's not just the operations function, whether you're running a sales team, whether you're running a product development team, the finance function, you have the same requirements. You need to deliver your services to a higher standard of quality, a better experience at lower cost with less risk. And that's operational excellence. It doesn't have to be in the lending department or in the payment processing department. And the one common refrain that I guess that just sticks in my mind from all my time in banking is people complaining about, oh, we don't have any data. I think I've mentioned, that the first day that I started at sort of one of the banks, I asked the sort of the head of payments, how many payments did we process yesterday? And the answer was all of them. And it would have been sort of not too bad had he been right, but we didn't know. We didn't have the basic facts and data. We didn't know how long it took to process a payment. We didn't know what the rework rate. We didn't know where the bottlenecks were. And so back in 2012, when we were deep in the Euro crisis, and we were concerned about sort of some of the Greek banks defaulting, one of the critical things in a payments environment is you need to be able to pull your lines really quickly. No one wants to be held accountable for sending a payment to a failed bank. Having the data available to say whereabouts are the bottlenecks, which part of this process is going to increase the delay the most, and where do you need to focus so you can drop those lines quickly? We just didn't have that operational data. And so use process mining to build your fact base around exactly what happens. You don't need to have then any other performance management systems trying to capture this, or tick sheets or all the other things, because you've got data from the source, which really tells you exactly how your processes are operating. So that's on the operational excellence. And I think that underpins everything that, that I see in this area. With digital transformation, it's a different sort of, a different topic. And it's mostly because pretty much every bank is doing it, and they know that they have to digitize parts of their business first before they become sort of, a true, to try and emulate the digital natives. And the key thing, unless you're going down a greenfields path, unless you are really starting from scratch, at some stage, you're going to have to migrate customers. And that is extraordinarily risky because of all the variation we've been talking about, the unique circumstances of particular customer sets, of how their banking relationship has been established. You need to understand that if you're going to migrate customers successfully. And once again, both understanding the as is, whether this is we're going to take deposit customers only first, or are we going to take cards customers first? And then is it just customers that only have a cards account but don't have any other sort of relationship with the bank? You understand that, but also, as you say, you can compare the as is model with the to be model to make sure all the controls that need to be transferred are in place. Because what's very common is the team building the new, they're pretty excited. They realize how much of an impact they're going to have. Then they're not necessarily thinking about all that baggage and all that regulatory risk and all the operational risk that has been seen to be part of the problem in the past. But whether you like it or not, you've got to sort of embed some of those controls in your new processes. And this, for me, is a great way to help de-risk a transformation as well as accelerate a transformation.
Thank you, Nigel. Meanwhile, we got a question from David Bartholomew, and he's touching upon another painful area in banking these days. Guess what? Compliance. So Nigel, compliance demands is a great reason for the need to understand our real process, which is highly digital and rapidly changing. What are your thoughts in this respect?
Couldn't agree more. So when I was running sort of payments at sort of both banks, and every 6 months, what used to happen is the finance and the risk guys would come to see me and say, we'd like you to attest to the fact that there's nothing happening in your business which could materially impact the financial results. And that was sort of slightly facetiously, I would say, but I process payments. I only need a couple of transactions to go wrong every day, and I will impact the material results of the bank. And clearly, the banks have significant controls in place to try to stop that from happening. But I could never put my hand on my heart and say, I know that every single transaction has been executed in line with expectations and the standards. And I think sort of, when with what sort of David's talking about, where David's going through, is the regulatory burden is increasing all the time. It was called out in the Royal Commission that there are just too many regulations and that we need to sort of to simplify them. There are too many exceptions to it. But until they get simplified, and that may take a long time, we have to accommodate them. And of course, with processes which are largely automated, they're invisible. And one of the things that struck me was one of the banks I worked with, within a couple of weeks of starting, we were having to repay a particularly large institutional customer because they had an account structure that had been set up, which was a sweeping across multiple accounts, and the wrong rates had been set up. And we didn't see it for several years, and they didn't see it for several years either. And so then trying to recreate those positions to sort of to make good for the customer is extraordinarily difficult and extraordinarily complex thing to do. So when you've got invisible processes that someone's just tweaking out of the goodness of their heart, you've got this massive regulation that's constantly evolving and changing. If you don't have this compliance and conformance checking happening both at design time, at runtime, and in a post-execution way, then you will never be able to keep control of what's actually happening within those processes and be safeguarded. And I think one of the other components we talked about, when I used to interview assurance managers, one of the questions I said was, let's talk about how we're going to measure your performance. I don't want someone that's going to come and tell me all the bad things that have happened. I want someone to come along and tell me what's about to happen that's going to go wrong and what we can do to address it before it does go wrong. So what can I do to avoid breaching my compliance obligations? How can I preempt them? And clearly that's the sort of technologies and tools that are now becoming available to make it much more realistic. So yeah, it's extraordinarily complex because of both the massive regulations, the massive processes that are largely invisible, and they're changing continuously. However, the technology is getting better to handle it. And that's one of the things that's really occupying my mind is it's easy to think of these are all of our requirements, and any process can have hundreds of requirements attached to it. But you don't need to evaluate every single requirement at every stage in the life cycle. There are some you only need to check at design time. If you've got 14 seconds to process a payment, you can't check every single payment in real time against all the requirements for that payment. You can only check a handful of critical aspects. And then in the post-execution, do you do that at the end of the day, the following week, or is this an audit scenario 2-3 months hence? You can spread out which requirements get tested when. But first and foremost, you need to understand them. And that's a challenge in its own right.
So, yet we hear from the news, as you were saying, that banks get fined more and more often because the pressure from these regulatory frameworks is very, very heavy. There's so many rules to comply with that objectively is very hard to keep track of all of them. So, as a bank executive, I could see why I could be tempted to just pay the fine and get going. It would probably be more cost effective to bear the cost of the regulatory fine than to address all these compliance requirements by design.
Well, I mean, I think
Can you help me change my mind?
Yeah, so that point actually came out in the Royal Commission findings, actually. And it's funny because when I started running payments at NAB, the regulator everybody was really concerned about was OFAC, which is the US dollar regulator, because the US dollar regulator was handing out billion-dollar fines, $10 billion, I think, in the case of one bank. And so that was, whatever you do, don't upset OFAC, which was, trade sanctions and things like that. But in the last couple of years, we've seen the penalties that have been imposed on both CBA and Westpac, and those penalties are serious. But also the reputational damage from those hearings that were sort of on the news pretty much every night from the Royal Commission. People recognize that quality and risk are two sides of the same coin. That if you want to deliver a great customer experience, you can also deliver a much less risky experience. Now, that doesn't sort of solve the issue of the volume of regulation and the amount of change. And some of the techniques that I've been, I guess, studying in the research I've been doing, which looking at how to extract the regulations, but also to understand the conflicts inherent within regulations, and then remove the redundancy in regulations where the regulations are deduped, that certainly seems to be sort of gathering pace. Somehow you then need to be able to connect those regulations to the underlying processes. And of course, that's where we sort of, once again, you can either take it straight from the source documents, or, things like, if I know that I've only had 5 transactions that have breached regulations, and I've got an event trace for all those 5 transactions, why don't I use those as my patterns that I'm going to conformance check against, rather than trying to get every last abstract detail into a process model to check against. So I think there are different ways to skin this cat, and unfortunately there isn't a simple way to do it. The other aspect that's come out time and again, both from the sort of the issues with the AUSTRAC around the CBA and Westpac, as well as the Royal Commission findings, is this need for alignment, and an alignment between the executive and the leaders of the functions that are actually doing the work. And sort of within an Australian context that's called the Banking Executive Accountability Regime, if I'm an executive, how do I get comfort? If I'm a board member, how do I get comfort that my team are actually doing the job? And if I'm a manager, how do I know that everything's actually worked the way it's done? And in the past, we've relied on detective controls largely, and we've relied on auditors, and we've relied on sampling. We don't need to do that anymore. We can rely on the actual events, the actual cases, the actual logs of real data, the whole population, not just a sample. And so that once again gives me much greater confidence. And when the way that the data is then sort of consolidated and presented, it can be prepared at a level of abstraction suitable for our executives. They just want to see the dashboard. They just want to know that when they drill down from that sort of little smiley face or the green tick, that they don't come to a jarring halt where there's the sort of and then a miracle occurs box. They can drill right down to the underlying case, the underlying transaction, and all of the events that have happened in there. That for me gives me the greatest confidence that we can actually sort of make progress on something which is both extraordinarily costly and extraordinarily difficult to manage.
Thank you, Nigel. Meanwhile, we got another question from Adriano Dambra. He says, the pain point in process mining is always getting the hundreds of thousands and millions of transaction records. Having this process's legacy, decision legacy scenario, can you tell us about the experience of collecting and homogenizing all the data? What type of strategy would be most appropriate to get fast results?
I think that's one for you, Marcello, isn't it? So you've probably
okay, I can take that one. So, Adriano, I can tell you that in our experience, we proceed incrementally. We start by looking at those core processes, one process at a time, for which the quality of data is high enough to get us started. As we address that process through process mining, and we start getting results that can help us justify the point of establishing a process mining initiative, we basically build a business case for cleaning up data of other processes. Now, that cleanup can take different forms. Initially, we can do that manually as a one-off exercise, but as we understand how to clean up the data, these days there are ETL tools that we can use to build such data pre-processing pipelines. So we automate data ingestion. We can schedule this data ingestion at a given periodic cadence, like every Monday morning, every quarter, every fortnight, so that we do not have to repeat this laborious activity. And as you build your business case, then you can use that as a leverage to push for some more data preparation activities. And sometimes the data is there but needs to be cleaned. Some other times the data needs to be produced in the first place. So for example, as organizations gain higher levels of process mining maturity, they realize the importance of logging different type of information, because the rule is quite simple. The more you log, the more attributes you log, the richer is the type of analysis that you can get out of process mining. And that has been our experience in short, and there is no kind of magic wand. You have to proceed incrementally. These things take time, but then once you have, say, systematized your process mining initiative, and you are applying process mining on a systematic basis over multiple processes, then you will definitely magnify the advantages and the benefits of process mining.
One of the follow-up questions, Marcello, that Adriano had was, well, what happens if it's not a digitized process? And funnily enough, I was talking to a business architect from one of the Kiwi banks over in New Zealand earlier this week about the challenge of where you've got lots of some processes in banks where a lot of the work is done through manual email exchange, or you've still got paper involved in the system, and that's really tricky. But at some stage, whether you can go down like a task mining, there are tools that can actually help look through the natural language of those email exchanges, so you can start to do it. But as with all processes, you have to start capturing data in some way, shape, or form. You have to find a way to do it. It's very hard to improve a process until you start to get some of those base facts on the table.
And from a technology viewpoint, there is another emerging technology that is called task mining. So task mining allows us to basically capture those user interactions that take place on top of desktop applications, like emails, Excel spreadsheets, web forms. For example, we've adopted techniques from task mining within the University of Melbourne in the context of the student admission process, where manual tasks included transferring student records from an Excel spreadsheet to a web form in the student management system. So these task mining tools can basically log these actions performed on top of these desktop applications, and then we can feed them into the process log. So we can feed this user interaction, or UI logs for short, into an end-to-end process so that we can also obtain this finer grained level of analysis. So basically we can move from the process view down to the level of the routines performed within each task. Now, if there is no way to get these logs, maybe for security or confidentiality information, we can try and fill these blank spots by using traditional business process management techniques, or traditional discovery methods such as observation, interviews, and workshops. Clearly, we know that these techniques are highly biased, lengthy, and error-prone, but that could be used as a last resort. So Nigel, we touched upon operational excellence, digital transformation, and compliance, and operational risk management. Another topic that you dealt with in your White series is customer experience, or customer journey transformation. And that's a huge buzzword these days. We keep hearing over and over again about the importance of mapping the customer journey. And we know that it's a contended area, an area where those who succeed, especially the tech giants or the fintechs, are able to take over customers from the traditional banks. So undoubtedly, these days more than so, customer experience is of utmost importance. But we know that there's a plethora of tools out there to help us understand the customer experience. For example, we can do, scenario mapping, focus groups, run web analytics, we can prototypes, and of course we can do customer journey mapping. Why process mining? What would be the added value of process mining over and above all these existing techniques that help us understand the customer journey?
I mean, it's such an important point, Marcello. It's funny, I was talking to a friend yesterday who is a New Zealander, a Kiwi, and he and his partner are looking at sort of buying a property over there, but they sort of currently live in Melbourne. And he wanted to transfer the money for the deposit. And obviously that's higher than his normal internet banking limits. And he went through a series of phone calls, and the last phone call was, you probably better go into a branch and do this. Now, you could never imagine a digital giant sort of even well, they don't have branches, physical property, really. So how would you do that? And I think this is, once again, it's one of those legacy decisions that, processes have been built up around the infrastructure you had and around the systems you had at a point in time. And it's just difficult to try and get away from it. But banks know that. They know that their customers are reaping the benefits of shopping online, using the likes of Facebook and sort of Google and Twitter, etc. So they've got used to digital interfaces. They've got used to that sort of real-time experience, and that they have to follow suit to keep up. And the sorts of tools and techniques you're discussing are absolutely fantastic. The idea of, what am I thinking about? What am I feeling? What am I actually doing at a certain point in time? And where does that customer journey start? It doesn't start when someone walks into a branch. It starts way before that. It doesn't start when someone comes onto your website. So I think, that momentum around the banks recognizing that they need to be far more customer centric is a great thing. And you can look at just the development of banking apps over the last sort of few years, and they have come on in leaps and bounds. The functionality, the ease with which you can navigate them is significantly better. However, there are a couple of things that I think the current tool set doesn't really help with. One is, it doesn't matter how much time you sort of spend on your design thinking, on your customer journey mapping. If you want it to happen, you have to anchor it in a process at some stage. So clearly, once you've gone through those exercises to really understand sort of, what your ideal situation from a customer would be, you then have to build it into a process. And some of those tools say, well, if I've got to build it into a process, how do I move from where I am today to where I need to be tomorrow? Once again, we've already talked about the role that process mining can play there. But more importantly for me is this idea that when we do customer journey mapping, what we're really doing is just looking at one episode. And we know that in banking, banking customers tend to be very sticky. They tend to be around for quite a long time. And whilst there's a lot of focus put on like a home loan proposition, the critical moments of truth, it's a serious decision in anybody's life. And banks are desperate to try to improve their value propositions in this regard. Most people have most of their interactions with a bank via transactions, via payments, moving money around. And if you happen to sort of stuff a customer around with their payments, then don't expect to win their home loan business. And what you can't see when you do a customer journey map is that life cycle, that lifetime value of the customer, the fact that all of these episodes are actually stitched together, and that the interaction with the bank normally goes, it bubbles along. It's quite a lot. It's pretty automated with the payments things. Every now and again, a customer may need to speak to a contact center, but then you have these major events, such as getting a home loan or starting up sort of a new investment sort of products set, or trying to fund your child's education. These are major life decision points, but the customer has been impacted by all of those other more routine transactions. And if you've failed to get their salary in on time and they've missed their rent, or you've set up their home loan and then you haven't set up the direct debit correctly and the first payment fails and they end up in collections, these are horrendous experiences which shape a customer's perception of the organization. What process mining can do, it can stitch those together. it can stitch those multiple episodes. So you can take a persona group and say, let's, how do we design the home loan experience, and how do we design the payment inquiry experience, for example? And let's have a look at what the data is saying about how many customers have had issues with payments relative to what this type of persona that is about to go through a home loan. And so that's a very different proposition than just doing journey maps in isolation of each other.
So Michael Beckett came up with a question. From my experience, I see banks and superannuation companies are very similar in terms of processes. Is there any elements of process mining that you are seeing that could be unique in the superannuation industry?
I don't know about sort of unique in the superannuation industry. I think that you're right to say that many of the things that I've spoken about apply across financial services as a whole, whether it's insurance, whether it's super, managed investment funds, etc., or banking. Now, the reason we talk about banking is because most of my examples naturally come from a banking context. My partner works in investments and life insurance and superannuation, so I pick up a lot from her about the issues. And they're very much the same. Now, each of those industries has its own sort of unique processes, how to, some of the actuarial work that goes into sort of to value in life insurance policies, how to take out a policy, how to pay out a policy or to make a claim, how to sort of to make sort of routine transactions into your super fund, how to set your employer up. But the underlying issues that they deal with are very similar. They've still got a huge amount of regulation that's governing them. They've still got legacy infrastructure that they're trying to move off. They've still got sort of, essentially what should be a totally 100% digital business. And it's not there yet. So they've got to manage that migration, and they're handling high volumes of transactions, some of which are fully automated, some of which have manual intervention. So I think at a very principled perspective that pretty much everything that I've said, how I think process mining can sort of help sort of banks support their existing transformation programs, that applies to super industry as well as the insurance industry and other aspects of financial services.
Thank you, Nigel. Now the $10 million questions. So I've been engaged with a number of large organizations, including those in the financial sector. And as we were discussing before, there's lots and lots of initiatives that these days these large organizations are engaged in. There is a team running the RPA initiative, so finding opportunities for automation and pushing automation. There is another one exploring chatbots and cognitive AI. There is a data analytics team exploring deep learning and the digital transformation happening and the pressure about compliance to regulatory requirements. So yet another initiative, Nigel. Thanks, but no thanks. There's already quite a lot in my plate. So how can we make sure that process mining can be effectively implanted in a banking context and it actually sticks?
I think you're absolutely right, Marcello. All the sort of the connections I have with my former colleagues and clients now is just how busy people are. And you say that comes at, so it's a bit like a matrix. So the 5 papers we talked about, they're really sort of very 5 broad transformations that are going on in most banks. They're looking at their operating models. They're looking at their, how they provide better value propositions to customers. They're looking at how they can manage their risk portfolio more effectively, how they can digitize their business, and how they can sort of, manage their efficiency and get their costs down. And then if that's on the horizontals, on the verticals, you've got the individual technologies which are supporting this, sort of whether it's I've got an AI drive, I've got an RPA drive that's going on there. And so for me, adding another thing in is problematic. If I was still in one of the banks and I was an exec and someone came to me and said, oh, how about kicking off a process mining initiative? I'd say, I love the idea, but I just can't get around to it at the moment. But what I can say is that the techniques that I see within a process mining context, are able to support every one of those major strategic transformation programs that an organization has going at the moment. And more importantly, they can help them deliver the outcomes not only were the ones they've got planned, but probably more outcomes than they have. They can deliver them faster, and they can deliver them to a higher quality specification with less risk and less cost. So that is, you prosecute your current agenda faster, better, cheaper. It's not another initiative. And if it's seen as just another initiative, I don't think it would sustain, because lots of these initiatives, they run out of oxygen because they just can't get through the funding process. You know, every year when the annual carve up of funds goes around for capital programs, I can't remember a year in my 15 years in banks where the program isn't oversubscribed by at least 70%. So it's just hard to get onto that prioritized list. And I think the latest KPMG data I saw about where banks are spending their money and their financial performance, something like 50 to 60% of the capital program is now spent on operational risk or risk and compliance. And so, you know, if you've got that much money going into risk and compliance, none of which necessarily drives a better outcome. There's lots of that is the remediation from the programs that have come into place since the Royal Commission. You've also got businesses that are desperately trying to keep up, adding new features, new functionality to their current product set, whilst at the same time you've got the digital transformation going on, trying to build tomorrow. It's really hard to add on another thing. But to support and accelerate current programs is a far more effective way of building the momentum and building the knowledge and capability and embedding this type of this range of techniques into the fabric of the organization.
So process mining as an enhancer
Yeah.
for other initiatives rather than an initiative, a standalone initiative on its own, right?
And I think that's it. That's in the banking context, because their agenda is just so full. Now, clearly, if you're in a business which is just chugging along very nicely, very pretty much steady state, but you're looking at how to take yourself to that next level of development, it can be a very fundamental underpinning of a new transformation. But I think it's quite hard to do that in a bank with all the other things that they've currently got on their plate. And for the executive airtime, many executives haven't come through an engineering background or an ops background, and some of the value inherent within the both operational excellence and process mining, it's not necessarily seen the way it could be seen. It's not seen as they're delivering quality and delivering revenue. It's just seen as a cost-cutting tool. So I think it's a way of supporting existing agenda primarily. If you have an executive that is an evangelist, that is the one way to really get these programs to succeed. Someone, one down from the CEO, possibly two down from the CEO, says, we're just going to do it. And they're going to be around for a while. They're not going to get moved on every 6 to 12 months like many execs. But if you've got someone like that in place who has bought into this as a critical component tool set to help the organization transform, that's possibly the way that I see that you really do get you get traction and momentum very, very quickly in that case. Much harder if you're trying to build it from the ground up, but sometimes it can be more sustainable if you've got multiple pockets of people who are just true believers, but they're at lower levels in the organization who are just trying it out and really building momentum and then forming a community themselves. So you can do it both ways. The latter is much slower. The former is faster. Probably more prone to risk, because who knows how long these execs going to stay around for. But for me, the positioning is really for the funding to get funding, significant funding, is to go as a support for other existing initiatives. So you're not as a standout line item on the spreadsheet on your own
that can be cut in case we need to play on a cost leadership strategy, but rather it's coming out of different pockets. And helping these different agendas.
So each of those 5 transformation initiatives, the major banks will probably be spending, I think each of the major 4 banks in Australia spend about $1 billion a year on capital programs. You only need to shave off a few percentage points from each one of those, and you can fund some process mining initiatives.
Indeed. And then, of course, it can grow incrementally over time as it proves beneficial. Let's open the floor to some questions. It's already about time. We got two more. So Sergio Costabile is asking, banks usually use business process management tools to handle their daily operational processes. How can process mining increase efficacy of existing process management tools? I think I can answer that one. So process mining is not meant to supplant existing BPM initiatives, but rather using the same term we used in the previous question to enhance these initiatives. So there are different process mining techniques that can support the various phases of the BPM's life cycle. We can use, for example, techniques for automated process discovery to complement existing methods that rely more on traditional techniques like workshops, observations, interviews, so we can accelerate the discovery and make it more factual. We can also use a range of analysis techniques to support our analysis, chasing hypotheses or validating hypotheses. We can use techniques from process simulation in combination with process mining to simulate different interventions, so we can aid the process redesign phase of the life cycle. And ultimately, in the monitoring phase, we can use techniques for real-time predictive and prescriptive monitoring to support the monitoring of our processes, to make sure that they adhere to the targets of the KPIs that we used as a starting point for our project. So definitely process mining, not as an antagonist to BPM, Lean, Six Sigma, and established methodologies for process management, but rather as a complement, as an accelerator for these existing methodologies. So Nigel, we've got another question for you from Lena Weisenegger. I think process mining and RPA can be complementary. So for everyone, RPA stands for robotic process automation. So that you could find out with process mining which processes have little variance and would be good candidates for automation. Have you had any experience with banks adopting such an approach, that is the combination of RPA and process mining?
I've suffered the consequences of not adopting the approach. So at ANZ, we were one of the first banks to really get stuck into process mining. It is particularly over in our Bangalore team. And they did a fabulous job at sort of, identifying RPA as being a potential solution to many of the sort of the manual processing issues that we had. And they took to it with gusto. It was a great unleashing of energy. And I think it's like sort of 200 or 300 RPA applications were written in the first year. But the yield was very low because we weren't picking the right candidates, or we were sort of tackling sort of one sub-process of 100 variants. And so we weren't really getting the value because we hadn't actually gone and done sort of that full sort of improvement cycle of sort of, consolidate, standardize, simplify first before you automate. And I think you're absolutely right in terms of your expectation. If I had been aware of process mining at that time, doing the discovery, finding the variants, looking at the sort of the performance roadblocks, we also tried to tackle automating processes which were far too large as opposed to just small components. So we just got stuck and bogged down. Whereas if you use process discovery to identify and performance mining to identify where a bottleneck is, you can just target that bottleneck. And so I think you're absolutely right, Lena, and I would love to be able to do it now.
Thank you, Nigel. So basically, this brings us to the conclusion. It's already 5:34 in Melbourne. And for everyone who has to go, we would like to thank you for participating in this seminar. And for those who want to stick around, we can handle a few more questions, maybe in the next 5 to 10 minutes. And I can already see that there's at least one more question that is popping up. But I would like to launch a final poll while we answer the next question. And this is just for our marketing team to collect a bit of feedback. So how did we go today. Give us your rating for today's event so we can learn and, of course, continuously improve. All right, so Lana, thank you very much. She says, thank you very much for sharing your expertise. Very interesting. And Adriano D'Ambra has come up with another question. What is the minimum team, I guess, for a process mining project, and what profiles would be ideal to carry out this type of process mining projects in banking? So maybe I can take that one, Nigel. So in our experience, you need some profiles. You need, first of all, to have the figure of the profile of a process mining analyst. That is basically the person who's gonna run the analysis. And of course, depending on the scale of the project, its complexity, you may need multiple analysts, right? Then, depending on how easy or hard it is to extract data, you may need to tap into the expertise of a data engineer that can help you extract the data. So at the bare minimum, I would say the analyst, at least in our experience, we have the process mining analyst, the data engineer or a system administrator that is able to extract data from one or multiple systems. And of course, if complex data transformations are required, then the data engineer or the data scientist can help you with that. And finally, you need a subject matter expert from the organization that can help you validate the initial findings, and as you get through your process mining projects, the results, the insights that you gain. So validate the initial findings to make sure that you are on the right track, both in terms of data and insights that you are getting, and then throughout the project, making sure that what we discover is indeed aligned with the outcomes that the organization expects to achieve from this project, to make sure that we maximize the benefits. And of course, as Nigel was saying before, you need to have a sponsor, somebody who's willing to put a skin in the game, to fund and push through the project for it to succeed. Clearly, as anything else, the higher the sponsor, the higher the chances to get through and to get through faster. But to conclude, you don't really need a huge team, and at the bare minimum, an analyst, a subject matter expert, and a sponsor would be enough to start.
The only thing I'd add, Marcello, is that we've had a lot of discussions around where do you start, and I've spoke to lots of colleagues that sort of the process professionals who are working in the banks about this. We come up with trite solutions like push on an open door. So if you've got a senior sponsor who says we'd like to try this process mining, that's a great place to start. The other area is don't bite off more than you can chew. From my experience, banks are notorious for their intolerance or their impatience for results. If you pick like the end-to-end mortgage process as your first project, you can guarantee that people will be bored within sort of the first 3 to 6 months. If you pick one part of that, maybe the credit assessment component or maybe the settlement component, gain momentum, get results, get sort of runs on the board quickly, is my recommendation with this. And as you say, if you pick one sub-process in the mortgage process or something that's a little bit smaller, maybe something that has got fewer systems involved to make that data extraction a little bit easier, then you're going to build your case very, very quickly, as opposed to you've got a bunch of people that scurry off to the sort of the depths of the data center and trying to extract data from 47 different tables without a common identifier, but sort of creating a synthetic one. So push on an open door, don't bite off more than you can chew, build momentum would be my case. And I don't, as Marcello says, you don't need to have 27, 37, 57 people doing this. It can be a really small, nimble team.
That of course can grow over time as the scope of the process mining initiative expands. And on that note, I would like to call it a day. So Nigel, has been a pleasure to have you here. Thanks a lot for your insights and for your willingness to share your vast experience with us. So we will follow up with an email. And of course, if you want to know more about what we do at Apromore, feel free to take a look at our website. And if you haven't done it yet, you can download the series of 5 white papers in banking that Nigel has authored. You can find it under the resources section of our website.
Thank you, everybody.
Thank you. And thank you, everyone, for attending. Here are the results of the poll, and most of you have ranked it as excellent or good. That's, of course, very pleasing to see. Thank you very much. Till the next. Take care.